Hello and welcome to CAP STRAT this week. Today we will be talking about more inflation, to the Fed's dismay potentially, and bubbles.
Yep.
Are we in a bubble? Is the stock market in a bubble? We'll discuss more, but we'll start this week with U.S. equity returns through March 12th. We've modified this table a little bit to start with month to date, but I think where a lot of eyes will be drawn, Mike, is on this 1 year return column. Particularly in the large growth space, over 50% return for large growth over the past year. That's a pretty eye-popping number.
It's pretty good.
Yeah, not bad.
That's pretty good. Yeah, that's pretty much since, this is about 1 year since Silicon Valley Signature Bank. So we talked about in the prior video that the 1 year numbers for large growth were going to get pretty big. That's happening. So, and especially compared to other areas of the market.
Right.
You know, more than twice the return of other areas of the market. And then of course we know within large growth, which is roughly 1,000 stocks represented here, if we focused on just the 100 largest and then we narrowed it down even more and focused on sort of the 7 largest.
It's better and better.
Exactly, that 50 goes up pretty quick.
Yeah, more than twice as much as small cap, more than 3 times as much as foreign equities over the past year. That's pretty crazy. And you know, you get the longer this goes on, the more you hear about, you know, all these all-time highs. It just keeps going up and up and up. Are we in a bubble? Is this too much? And luckily, we've got our trusty framework to help us think about that.
Yeah.
And that's what we're looking at here. Our different areas of the U.S. market. So we're looking at large, small, growth, and value are the 4 different lines here, and their distance from their own long-term trend. So Mike, talk to us about it. Are we in a bubble? What's going on with these various areas of the U.S. stock market?
Yeah, the discourse around bubbles is useless. It's to put it bluntly, there's so much noise, and the articles that are written, the analysis that is done, it's not very useful, practical, if your job is to actually manage money and make decisions around how to invest assets. So some of the things we see, you know, probably ranking from most useless to, you know, better than that, but
more
still
useful.
Yeah.
Sure.
The most useless is the amount of time spent near the all-time high. Markets spend about half their time within 5% of the all-time high. So if every time you're near the all-time high and you want to sell, you're going to miss out about half the experience.
Yep.
And you're not going to get very good outcomes. So that's pretty useless.
It's funny, you know, the more recently you've been at an all-time high, the more likely you are to hit an all-time high sometime soon.
That's right.
Right.
That's right. So that's pretty not useful. And also what you see is relative to the fundamentals. So you look at the equity market now, you take a sector or a certain area of the market, and you look at prices relative to something. Relative to sales, relative to enterprise value, relative to tangible assets, relative to GDP, whatever. Yeah. And that can be interesting, but there, you pick your metric.
Yeah.
And it's more so what ends up happening is somebody says, well, this is what I want to do, and I'll pick the metric to justify it. So that's where we'll talk to large growth managers, we'll talk to active managers in the space, and if they're bullish, they'll throw out 10 metrics that say we're not in a bubble, and if they're bearish, they'll throw out 10 metrics that say we are in a bubble. So that's not very useful, and we always inevitably go back to comparisons to 2000.
Sure.
And how much, if you're a bull, hey, don't worry about how expensive we are now, it's less than 2000 than we were in 2000, and the economy is different. Companies are more asset light, so they should deserve a higher valuation. You know, earnings growth is better. And these things aren't very useful either. So this is a big question that we have to tackle within our investment framework. And, you know, what we do when we think about valuations, as you said, we look at the distance from their long-term trend. So if you take any asset class, you can plot the returns. In our framework, we do it since 1960. And you know that'll go up exponentially because compound interest is the 8th wonder of the world, right? Yep. So that's sort of hard for the human brain to comprehend. So what you do is you put it on a log scale, and then it turns into a linear trend, which is much easier to see. And then you can draw a trend line. And are we above trend or below trend? And what that question that basically answers, if you're above trend, what that says to us is there has been excess risk taking, so above the long-term average risk taking in this area of the market. Perhaps there's a bubble. Then we have to say how much excess risk taking has there been.
How extreme has that gotten?
Exactly. How extreme has that been? So that's what you see here. And things that jump off the page, the NASDAQ 100, these are all these different areas of the equity market, distance from their long-term trend since 1960. Right now we're 67% above trend. Is that a bubble? Doesn't look like it. I mean, in 2000, we were 300% above trend, right? So all we know is there has been excess risk-taking in this area of the market for a pretty decent period of time. Is it in bubble territory? Probably not, because if you're 67% above trend, that excess risk-taking can clear up in a few ways. One is, what can happen is what happened in 2022, prices go down. And the bubble's popping, the bubble's deflating, right? The other thing that can happen is these prices can stay stable, your trend is positive.
Trend catches up.
Your trend catches up.
Sure.
This does not seem insurmountable. It does not seem like historical wackiness. Relative to other areas of the market, though, it seems excessively excessive, if you will. So when you're managing portfolios, you're always looking for relative value opportunities, right? And if you go back to the 2000s, every area of the equity market was above trend. So it was sort of pick your poison. What's the least bad option, the cleanest dirty shirt, if you will? Thankfully, we don't have to do that this time around.
Right.
As we've talked about before, smaller cap areas of the market are below their long-term trend. They're cheap. Value stocks, just on the other side of the value growth spectrum, large cap value stocks, are basically at their trend.
Yeah.
They're only 8% above the trend. Those valuations are not alarming at all. They're very supportive of positive, strong future returns if you were to invest today. So definitively, is there a bubble? We're not going to say that on video. I mean, come on.
Are you recording right now?
Yeah. But has there been excess risk-taking? Yes. Has it been excessive relative to its trend and relative to other areas of the market? Yes. Is there potential that the market could rotate out of these expensive areas into cheaper areas? Absolutely.
Right.
Yep.
Yeah. Two big things pop to mind here when you're talking through this chart. The first is you talk about active managers and crafting a narrative, right? Yeah. Well, so you look at this chart and you say, pretty reasonable, nothing too extreme. But if you're bearish, you just cut the axis right here and you say, wow, 67% above trend. Yeah. This has gotten extreme. This is out of hand. But maybe the more useful thing to draw from this chart that you were referring to is this potential for a rotation, right? The smaller cap areas of the market below trend, even large value at trend. And we've talked a little while about, what a potential catalyst could be to start to lift these other boats, if you will. And that being this shift in monetary policy, the Fed starting to cut rates and becoming less restrictive. Let's at least start with that.
Absolutely.
And, the biggest hang up to that playing out continues to be inflation. Will inflation unstick and get back down to that 2% level? And with that in mind, we got the February CPI report, and not the worst news you could have gotten, but not going in the right direction, right?
It was a continuation of the trends we saw. If you break core CPI into the sub-baskets, the trend in an acceleration in services ex shelter, we saw more of that over the six-month time period, which we know is the Fed's preferred time period.
Yep.
So from that standpoint, it just reinforced that March is totally off the table,
right,
for a rate cut. It was already pretty much off the table, but this definitely puts the nail in the coffin, if you will. It looks like May might be off the table as well, but June, July still, in our view, on the table.
Right.
How did the markets take this? Because this just got worse, right, from last time we looked at it.
Yeah.
But the market sort of took it in stride because although it was bad, it wasn't as bad as feared.
Right.
there was a lot of discussion around the shelter component and that re-accelerating in January. Some wonkiness in the data, some confusing accidental emails sent out by the BLS around owner's equivalent rent and whether the acceleration in January was real or an error.
Failed recall.
That was probably the most relieving part
Yep.
of the February report, was that shelter, the owner's equivalent rent, it was sort of an anomaly in January. It's going to normalize out.
Yep.
It's going to normalize out. So the market sort of took that in stride. This second to last inflation report that the Fed will get before they meet in March, the last one will be PPI. If you take PPI, you combine it with CPI, the Fed will basically know what PCE is going to be for February when they're meeting in March. They'll put those two together, they'll do the math just like we do, and they'll have a good idea.
Yeah, exactly. And with that in mind, taking a look at our core PCE projection, maybe another part of the reason the market was able to take that in stride. Still, you can see the expectation here, within the forecast horizon, getting below the Fed's 2% target.
Yep, so exactly. Different calculation methodology for PCE,
right.
The Fed's preferred gauge, not dealing with as many issues on the services side, especially around how inflation for health insurance is calculated, and not dealing with as many issues on the shelter side either. So the sort of trend in core PCE getting down to that 2% range by June, July, we think that's still intact. We said the January CPI report put a lot of pressure on the February. Unfortunately, the February puts a lot of pressure on the March.
Yeah, it has not relieved that pressure just yet.
So hoping we'll get some relief March, April.
Yep. Mm-hmm. Yeah. Awesome. Yeah, and to the point of markets taking that report in stride, you can see here for March, across the fixed income spectrum, some marginal positive returns flipping around some of those year-to-date trends, particularly in the long end of the curve with rising rates for most of the year thus far. Awesome. Let's get into the framework components, the other framework components, I should say, starting with liquidity. We referenced earlier this potential for the rotation and the Fed to provide some more support to markets in the back half of the year. Still in line with our expectations, no major changes there.
Yep.
And on a somewhat related note, economic growth projections, the endpoint here ticking up a little bit higher as we update those projections.
Expectations just keep ratcheting up. No doubt the February non-farm payrolls report, although January was revised lower, the strength in February sort of raised the endpoint of our forecast and a lot of other folks' forecasts as well.
Yep. And the other side of that economic growth coin, the recession signal, remains inactive and still, even outside of the yield curve, no even red signals from any of the underlying components of the recession signal. So, All right. Well, that'll do it for us for this version of CAP STRAT this week. If you have any questions or comments, please feel free to reach out.